Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name's Corey Kramer. Today, we're going to be taking a look at LKQ stock, ticker LKQ. This one came in by request down in the comment section of one of my other videos. If you have a request you'd like me to take a look at, just put it down in the comments. I will get the ticker on the whiteboard behind me, and eventually I'll make a video. I'm almost done with one of those columns now, so I'm getting caught up on everything here. As always, this is not individual investing advice. This is just how I analyze stocks. If you request a stock that's not in the S&P 500, I post those over on Patreon. Occasionally, I'll post them on YouTube too. But for the most part, my policy is if it's in the S&P 500, I'll post a free video. And if it's not, I post those on Patreon at the $5 a month tier level. I also have a $25 a month tier level on Patreon where I share a stock pick each week. I basically look at the market, try to find the best thing that's out there no matter what is going on, and share what that is. It's off to a really good start. I just started that service in October. And then, of course, I have the full Cyclical Investors Club service over on Seeking Alpha. All those links will be in the description, along with a 25% off affiliate link for Fast Graphs if you want to give it a try. You see me use it in a lot of my videos. I used it for years and years, and finally I was like, I use this in all my videos. I should contact them and see if I can get like a link for them, and they were glad to provide it for me. So I think they have like 2-week free trials. If you want to go give it a try, it's good for these type of earnings analysis. All right, so LKQ, auto parts, like usually repair parts, I think, company. I have a history with this one, which I'll talk about in a second. But if we just look at their long-term earnings growth, I mean, it's really pretty fantastic. And this little bump here kind of stands out during the pandemic, like mid-pandemic after the stimulus and everything came out. And now we see that that's kind of reverting back to kind of the mean, getting close to it anyway. So this was an interesting one. I hadn't looked at it for a while. So I bought this stock in the Cyclical Investors Club over on Seeking Alpha. Coming out, well, no, it was in the middle of the pandemic. So what happened basically was I saw the pandemic coming, and at the end of February went mostly to cash, like 70% cash. I bought like 30 stocks during this decline here in March. And I would say I was roughly 58%-ish if you don't count precious metals. I bought some precious metals too. Stocks and like 50% like cash and metals. So I had a lot of cash still during the rise of the market this year or that year. And I really kind of expected more problems. I mean, I was willing to buy, but I was looking for cheap prices, and I was being pretty cautious because things could have gone much worse. But I was still buying when things were cheap. So the stocks I bought performed extremely well. And then the election came, and so two things happened at the end of 2020. One, we got the vaccine announcements that they were coming out. So that was a bit of a game changer. Two, we had a Democratic sweep in the United States, and they were already announcing all the money that they were going to pump into the economy. So we had both of those two things going on. And at that point, I got more aggressive buying stocks. I didn't want to have nearly that much cash because, one, it looked like eventually the pandemic was going to end maybe a little sooner than I expected. And two, I knew there was a bunch of money going to get pumped into the economy. So this was one of the stocks that I didn't buy during the initial downturn, but that I bought later on, like I think it was in December. Maybe it was in November. It was, pretty much right after we can look at it actually, I'll look at it right now if I can find it. Yeah, so let's go see how we did on this one. LKQ somewhere right here. Okay, so it was November 2020, and then I sold it like a little over a year later. I have it as 15 months. Made 55% in a little over a year, about doubled the S&P 500 return. So that was good. So basically what happened was this one worked out really well because it didn't get affected by the semiconductor shortage and the supply chain problems and everything. I had some other investments I made during this time that were also, some of them were even related to the auto industry, that didn't work as well because they couldn't get the parts they needed to sell the cars. So, but this business actually took off like pretty much exactly how I expected over the next year. And then in 2022, I got really cautious at the very end of 2021 and 2022 because student loan repayments were going to be coming. It looked like some of the stimulus wasn't going to get through, or additional stimulus was over. The Fed was raising rates. There were all sorts of things. And so I sold a lot of stocks right here, basically at the peak of this period, by the end of January. I think I sold this one on the 18th, it said, something right around there. So it ended up pretty much being the top. Now, the stock price did recover in the next year here, but this one did exactly how I expected for the most part. And now that the pandemic boom is over and we're getting the bust, it took a couple years longer than I thought it might. The stock's down 33% since then. So it's pretty much done what I expected so far, and that's my history with the stock. I do track it, and we're going to take a look at the valuation. But when you zoom out this is one of the reasons fast graphs can be really useful. I mean, you can see this just visually. They have a steady growth rate, and then boom, pandemic, boom. Well, how long do you think that's going to last, and how much did they pull it forward? And well, it's probably not going to last forever, and then this is pretty much what you would expect over time. Now, the question is, does this go on like another year? Or is it going to bottom out and then start to recover, which is what analysts are calling for, but the market isn't yet. The market's still pricing it cheaply. So, but you can zoom out and just see the bump in the trend. You can see that boom bust. And the bust has been mellow so far, so we'll see how it ultimately ends up. It's also worth looking at basic earnings sometimes too. So yeah, so now we have an even bigger peak and an even sharper drop off, and that kind of tracks the stock price even a little bit better because they do quite a few acquisitions and stuff that can affect their adjusted earnings. It looks like the market's following the basic earnings a little bit more. So during a time like this, even though we're not in a recession in the wider economy, effectively LKQ is in a recession. I mean, they are in earnings. They've had declining earnings for 3 years, and the stock price is declining, and that's basically a recession, right? I mean, so the way I do this to try to estimate the value of something like this, now there's other ways you can do it. Now, it probably makes more sense when you look at the basic earnings and how fast they dropped. I'm not going to use that in my spread, like when I get to my spreadsheet, but you can see the problem with, like, say it traded at a 14 PE at the peak here. Well, it trades at a 14 PE now, right? So you might look at it and say, oh, well, the valuation hasn't changed, but the stock price has fallen 35%. Well, that's what happens when earnings fall 35%. So the whole recession metric that I'm going to try to talk about it can be a little confusing sometimes, but this is what it tries to account for, okay? The stock wasn't cheap at 14 PE at the peak because earnings were going to fall about 40% or 35%, and that ended up exactly what the stock price fell from there. So now analysts think earnings are going to climb the next couple of years, but they were wrong these years too. I haven't looked up, I didn't go back in history and double check it, but I'm sure they were. Or else the stock would have moved earlier when I sold it back here. And I was a year early, right? Earnings didn't, but it's better to be early because I didn't know when this decline was going to come. I just could kind of see that that's where the direction was eventually going to go, right? So let's get into kind of what I'm trying to do here. I'm going to base my buy price on, well, I can do it a couple different ways, but the main one I'm going to do is I'm going to base it off this decline in 2020 and treat this like it was a recession. Now, it was a little weird because of COVID and everything, but I don't think we have recession. Yeah, so here's the problem with going back to the 2008, which you can look at. One, it was a long time ago. They were a lot smaller company, and they actually grew earnings through that recession. The stock price still got creamed. Stock price was still down 60%. So this is probably not going to repeat. Sometimes you just have to use, like, it's unlikely their earnings grow 36 and 15% if we have a 2-year recession. And if that does happen, it's probably unlikely the stock price falls 60%. I don't know what the PE. Yeah, the PE wasn't much higher going into it. It was like 30. So it's just kind of a totally different setup here. And so I think the 2020 drawdown is just, it's not perfect. It's not a real recession, but it gives you an idea of how the market might react with the stock price. If it thinks it's going to, because the market didn't think they were going to earn 255 at the end of 2020. The market thought it was going to be a recession. So the market treated it that way. And also the peak price was back in 2018. So we can look at that, which was the peak of the industrial kind of cycle there. So it was, again, about 50, we'll call it 65% off its high off of that peak, which was a 23. But that was, again, that was a higher peak than we're getting up here. We're in the teens. So, you know, what was the peak here? Yeah, this is more like it, right? This is like around the same market valuation going into that decline. And then during this decline, it went down about 55%. So not quite as far, but we can see that the potential is still there for a big decline. And we're partway through into that decline. So the question is, how much farther might that decline happen? If you're just roughly estimating it, these are not predictions or precise. They want to keep you from really screwing things up, right? So I didn't sell at the exact top, but I was pretty close, and the stock price still rallied the next year and went a little bit higher than when I sold it. But I was mostly right, and I was able to make a good profit. And so that's kind of what we're aiming for here. So the way I do this is I take the peak earnings, which was $2.37 here, and the trough price, which was $13.31 in 2020, and I form what I call a recession PE. And what that does, that's important because this number is the earnings is stable, and the price can keep dropping, because otherwise what happens is, especially if it's a longer decline like we're seeing here, the market will just continuously get more negative. They will continuously get more negative because you can see the PE hasn't changed in 2 years. It's because, but the stock price has. And at some point, the market will, let's say next year's earnings are negative growth as well. Well, it'll go down that much more. And at some point, you want to say, okay, I'm going to assume that this business comes back. Assume this downturn works its way through and they come back. If that happens, similar to what it did in the past, how deeply might it go? What's a reasonable kind of range to aim for? So I'll have to look, but I probably use this $3.96 as the peak earnings, and then whatever the price is at now is what the price that we're going to form a PE out of, to compare it back there. And then usually I give a little bit of a cushion off the bottom. So I'll show you what I mean by that. So I didn't double check these numbers, so I'm just going to go from, okay, so I have peak EPS at 383. Did I use basic earnings for this? Maybe. I don't think so. 383. Okay, so I used 2023's earnings, which is almost the same. I use that as the peak instead of 396. I can actually change it to 396. I might do that. It's usually what I do. Let's change that to the actual peak, and then we'll see how it comes out. That's all I have to do, really. So these current, haven't updated this one since just the end of October, but let's see what the real earnings are. 345. So it's still the same. All those metrics are the same, except for the price. It changes. Okay. So we have the peak earnings, $3.96. I do adjust this. Let me make sure I adjusted it for the debt. Some of these formulas I do not. So this one, yeah, I did. Okay. So I adjust the price for some of the debt that they have. So instead of $37.98, I'm using $47.10. Okay. That comes from the difference between the market cap and the total enterprise value. And I probably did this before this last stock price drop, so it's probably actually worse, but I try not to adjust it down too much, or else I get into the same problem where I keep getting more negative with the market. So let me see what I have it at right now. So I have it at a 25% adjustment. So it would definitely be higher than that now, but I'm not going to keep adjusting this. That's enough adjustment. For if the stock price recovers, it will eventually come back to kind of this level that I adjusted for. Okay, so if you didn't understand any of that, just don't worry about it. Just I'm adjusting the stock price up in order to pay for the debt as well as the stock. This is just for valuation purposes. Okay, so if we use this stock price, we use these earnings, what kind of recession PE are we going to get here? We are going to, so the current recession PE from 2020 is actually 5.62, and then I add 40% to it. So if we have a similar decline from a peak earnings like this to a trough price like this, it would produce like a 5 PE, which you can see like a 6.7 is where it is on the fast graph. And what I do is say, okay, I'm not going to try to pick the exact bottom. I'm going to have a little bit of a cushion. So as long as the PE is 40% higher, within 40% of that, then I would consider buying it. So you just want to get down into that range somewhere. So what you want to do is not buy like here, right? And then still have to sit through a 45% drawdown, or have been a person that bought during this decline. See, I've just been waiting this whole time. So, but you don't want to always be too negative. You want to buy at some point, otherwise you miss this type of bottom. So that 562 is what this decline produced when I did the research anyway. And I added 40% to that. So that's a 7.87 recession PE. And if I use this price and these earnings, I want those two, this one will stay the same because it already peaked out. This one will keep dropping if the stock price keeps dropping. And eventually I'll get down to there. So let's see. If we do the math on that, it should come out to a stock price of like a buy price of $25.13. That's 33% lower than where the stock trades right now, because the real stock price is we'll just call it $38. It's not really too far away, honestly, at the rate that the stock has been falling. And you can think that if they have one more year of negative earnings growth, it could get down into that range, and then it would be worth kind of stepping in and buying. Overall, they have like a 6% earnings growth rate once like buybacks and all that stuff is taken into account, which is okay. It's not great, but again, that means it's a stock you want to buy when it's on a pretty deep discount. Not too much different than like Genuine Parts Company or something like that. Although these guys' growth rate has been better, a little bit better. And so none of this is super precise, but you would be amazed at how much money it saves you from buying too early, and then how many opportunities you do ultimately get during times of like weakness. And it's not a science. It's just to try to get a decent price, not buying too soon. And let's say you bought back here. Let's say you bought at this bottom. Actually, that would have been pretty sweet. You would have been up quite a bit, up 30% there in a year. Nice. But if you would have just kept holding, now you're down almost 15%. And that's over a period where, the stock market's done pretty well and inflation's up probably 10% or 12%. So you're not, even though you bought it on this first dip, because you still paid too much for it, you're down and you're kind of waiting, right? And then everybody else, of course, is way down, like significantly down. So having that patience, but not being too negative, because really the news is only going to get worse if that buy price hits. So everybody's eventually going to be bearish, or else the stock price wouldn't fall that far to begin with. And what this method does is it kind of, once you've been waiting for a stock to drop 50%, and it really does, then your mind is just working differently. You're thinking that, yes, I know it can drop that far because I looked and the market's done this before, and if I get a chance to buy it, even though everybody's really scared and crazy or just tired of holding this losing stock and selling it, that's when you can get the opportunity to come and buy and just have kind of a little bit of faith that if it's a decent business, it will eventually recover from whatever kind of downturn that they were going. Now, sometimes they don't, but if you buy cheap enough and you buy enough of them and you spread those bets around, you'll get some big winners. I mean, if you use the same method in 2020, and you bought it and you just held it, you would still be up 133%, even after this decline. So buying when things are cheap really pays off. But you can't be scared to buy when things are cheap, because the reason they're cheap is nobody wants them. All right, if you found this useful, hit this like and subscribe button. If you have a request, put it in the comments, and I will eventually make a video. Check out those Patreon links. I have a free tier on Patreon too, where I post all these same videos plus extras. I've been posting some thoughts of mine on Morgan Housel's Psychology of Money over there. I started it actually at the beginning. I started posting a couple at the beginning of the summer, and then I stopped reading while it was warm outside, and usually in the winter I read a lot more. So I've already finished it, and I still need to make some more videos for it. But that's over on the free tier. I haven't been posting those on YouTube, just Patreon. So you get some bonus stuff there even on the free tier. Okay, thanks for watching. I'll see everybody later. Bye.